So welcome, welcome, and welcome, everybody. We have members, we have members, attendees of the webinar from all over the world. I'm pretty sure that we're covering quite a few continents, which is pretty awesome. Isn't it pretty great, guys? You know, when I got started in trading, it seemed like it was just, we literally could log into our trading platform and look at charts, and that was it. And there was webinars and all that stuff. You'd have to go to a hotel conference room and pay $5,000 for the weekend for somebody to hopefully fill your brain and have it not overflow, and take it and use it for the rest of your trading career. And now we have these webinars. We can get together. Everybody can do it from all over the place, and it's really awesome. So I'm super happy to have you guys here with us. It's always great to be with everyone. Great to have all of you guys in attendance. Chris, I hope old is a state of mind, because I need to move states, I think. I'm creeping up. Yeah, the grail with holes in it. I love it. So guys, as we're getting started here, we have so much great stuff to talk about today. Some people in here are members of my live trade group, so this will be a nice refresh for you. And for those that are not, hopefully this will be some exciting information, because I'm really excited to share some of the things that have helped us be very, very profitable in our trading, in our forex trading, and what we do specifically in the trade group. And I love sharing information. So I do these webinars for free. I put them together. It's a fair amount of time and effort, but this information needs to get out there, and I want to make sure that I share it with you guys and that it's accessible to everybody, because we need to, sharing is caring, as they say. We need to talk about what's working. We need to share what's working, and we need to really step up our game when it comes to trading. So we're going to talk all about that, and I'm really excited to get going. Just real quick, so there's definitely a bunch of names that I don't recognize. So just tell me, guys, just type in where you're joining us from. If you feel like Big Brother's monitoring your internet connection, you can just say a continent, like or a hemisphere. I'm in the southern hemisphere, northern hemisphere. But okay, Dory, is it Dory? Dory from Sacramento, or is it Dor? Okay, Dory. All right, good. Where else we have everyone joining us from? We've got Sacramento, Halifax, Nova Scotia. Great. Center of the world, Toronto. All right, I love it. That is the center of the world. San Diego, but your VPN is LA. I love it. James from Missouri. Hello, James. Good to see you, my friend. Bob, of course, Las Vegas. Good to see you. Lucky Bob. Noel from Trinidad. All right, good, my friend. That's awesome. Noel, you've been with us for a long time. I've seen you in webinars, some of these webinars for, I would say, the better part of a decade, right? Somewhere in there. Florida Patty, good to see you. Happy to have you with us. Yeah, it's been a long time. I'm glad you've been with us. We got Chris from Niagara Falls area up there in Canada. Good to see you. Awesome, guys. Awesome. We have people from just all over the planet. So that's really good stuff. Okay, part of the reason I want to know where everybody's from is because I think it's so cool that we can get everybody together from all over the world. Number two, and this is a small number two, by the way, I want to make sure everybody can find the chat box, because I do actually desperately want to hear your questions. I want to hear your comments and all of that. So I'm always interested where everybody's joining us from, and I want to make sure everybody can see where you type in, where you do all that stuff. I guess the hope is that you'll just look, because I don't really know how to tell you where the chat box is. So it's somewhere on your screen. Anyways, guys, let's get down to business. This is exciting stuff. Again, very, very happy to see everybody, and very happy to have you with us. Wade, okay, you found it. Good job. Kevin, Long Beach, California, in 2 weeks. Russia. I think Russia's nice this time of year, right? Probably only about 20 below. It's not quite 40 below yet. So, woo, that's gonna be quite the trip. Good for you. Good luck and safe travels. Speaking of cold, guys, we are going to talk about the market temperature. Very appropriate, Kevin. Thank you for bringing it up. We're going to talk about the market temperature and how to effectively take that temperature. Now that I say that and I think of that, I should have had a really clever picture of, like, the sick market with with a thermometer coming out of its mouth or something. I actually have one sick child right now. I have 3 kids, and one of them is sick and has a fever. So what do you know? The market temperature, the kid temperature, all the temperatures. But we're going to talk about it specifically as it relates to trading. This is so super important because what we must do is we must take so much of this guesswork out of trading. The longer I do this and the more I do this, the more that I realize, number one, how just simply lucky I was in my early days of trading. When I got started in trading, the market would move hundreds of pips every day, and all you had to do is figure out, if the market moved up 50 pips, it was likely to go another 150 before the day was over. So I would just throw a trade on, right? And if it moved down 30 or 40 or 50 pips, if it took out a daily high or a daily low, it was likely to go another 100 pips. We are not in that market anymore. We're in a market that requires a lot of technical outlook, and the guesswork is not so easy. Back in the day, it was easy, and I had a lot of luck, thank goodness. But as it carried on, as I traded longer, as market conditions changed, very specifically over the last 10 years, kind of 2008 really changed everything. I had a great year in 2008, by the way, when the market sold off and crashed and went down the toilet. That was a great year for me, and all the years up to 2008 were pretty darn good because we had these huge movements. And then kind of 2009 came along, and all of a sudden we had this market that was much more temperamental and moved much less and became much more range bound and required us to really know what we were doing, right? And so in the last 10 years, if you have been trading, just out of a show of hands or a show of typings, I guess, who has been trading for nearly 10 years, give or take? 10 years. Anybody been trading since the 2008, 2009 movement? Mel, you have? Vlad, what do you think prior to 2008 comeback? Yeah, I think we could see some stuff. Kevin, 10 plus years. Dorothy, about 10 years. Rick, 1998. Is this Rick from Florida / West Virginia? Rick? Patty, yes. Okay, good. So we've got people that, Noel, yes, about 10 years. Chris, you think it's the algos? Okay, yeah, could be. There's that too. There's definitely that too. There's a lot of reasons why we have this slightly more range-bound market. But look at how many people in here have been trading for about 10 years since the markets really started changing, right? Mel, not rich yet, right? So we have work to do. We have so much learning to do, and this is where, unfortunately, it takes a little bit of time to really weed out that guesswork and really get a good feel for things. And so that's what we're going to talk about. That's what we're going to talk about today. It's very, very important, and I'm really excited to look at this. So people always ask me, to say, how do the banks and how do the hedge funds trade? Do they, it's algorithms and it's all this stuff. And yes, they use all that stuff. But banks and hedge funds look at what the market is doing. That's really how they trade. And that's how I'm going to show you guys to trade today, is how to really look at what is happening. We're going to take away these crazy special indicators, and we're going to, because that stuff is, people always ask me, what's your favorite indicator? What's favorite this, that, and the other? Yeah, I like pivot points. I use the 200 moving average. I think it's really awesome. But when it comes down to it, I need to know what the market is doing. And I can't, if I just watch the market go great for 4 or 5 days, that doesn't tell me much. That tells me, yes, the market's doing great, but if I'm not prepared for that, I'm not going to try to jump in and chase something. So I need to learn how to identify these turning points and how to get a good feel for what is happening at these big areas where the market turns from panicked to confident, or vice versa. So that is how everybody should be trading, and that's certainly how these hedge funds are trading and how these banks are looking at the market. So I always like to just throw a picture up of myself. Anybody that hasn't seen me, I'm actually wearing those pants right now. As we said, I'm a pretty casual person. I live at the beach half the time, and I live in the mountains the other half the time. And I just really love flip-flops and shorts. It was a cold day at Disneyland, so I had to have some pants on. But anyways, this is me and my family, and this is who you're talking to. So, you know, just to put a face to the name. Uh, yes, it's me with the polka dots, the red and white polka dots. Oh, absolutely. Oh my goodness, we got so much Disneyland in a couple weeks ago that my kids, I think, probably don't want to go anymore, which is, you know, kind of the goal. Um, Here's me when I try to not dress like a bum the other 6.5 days of the week. But Jared Johnson, founder of Day Traders FX. I've been running my trading group, my website, my everything for a long time. In fact, my website used to be called All About Pips, because I just thought that was great, all about pips. But then I didn't like that anymore, so I changed it to Day Traders FX about 10 years ago. But I've been running this website for a very long time, and I've been running my group for a very long time, and I've been trading for a very long time, and I've been training and consulting for a very long time. I manage money for clients. I run a trade group. I do some consulting on how to trade. Everything that I do all day long is trading related, unless I'm changing a diaper. And then I'm trading a dirty diaper for a clean one. So there's always trading involved here. So that's my spiel on who I am and what I do. So happy to be with you guys. Always good to do these webinars and to get together with traders from around the world. Who likes surprises? Does anybody like a surprise? As I mentioned a couple weeks ago, 2 weeks ago, I guess, I had a birthday. I turned 40 years old, right? I turned 40. Now I joke about it. I'm really old and you know, all that stuff. Of course, I don't think I'm really old, but sometimes I might feel that way. But surprises, I'll be honest, I don't like surprises. I don't like surprises of any kind, right? I had this birthday party and my wife took us over to our friend's house, and inside 50 people were hiding and they yelled surprise, and it just stressed me out, right? but because I need to know what's going on a little bit. But it was a great birthday party and it was wonderful. And surprise birthday parties can be so much fun, right? My kids love surprises. In fact, my kids love surprises so much that they can't hold it in. If they know something that's happening for anyone else, they have to talk about it because the surprise gets them, right? So surprise birthday parties are awesome. They're so much fun. They're so great. You know, if you win the lottery, surprise, that's awesome. Those are the good surprises, right? In trading, there are fewer good surprises and there's more bad surprises, right? And these bad surprises are, for lack of a better word, we guessed the trade we were taking, right? We guessed. Now, sometimes we can have all the information in the world and something bad will happen. You know, we can have all the information, we can put it all to work, and something still just doesn't work out so well. And that's trading. You know, it's not 100% predictable. But when you start to notice that you're having more frustrating days than not in trading, or if you've been trading for 10 years and you're not profitable, or and by the way, guys, I talk to traders from around the world every single day, and you guys might be surprised how many traders I talk to that have been trading and have never pulled 1 cent out of a trading account. Now, some of you in here mentioned you've been trading for a long time and maybe you haven't made millions from it, but your account's probably headed in the right direction. And I talk to a lot of traders that aren't, and that's okay. If you're one of those that you've been trading for 10 years and you've never made a penny, that's okay, because you're here and you're trying to learn something new and you're trying to change that. So that is awesome, and I seriously congratulate you and commend you for that, because that's really awesome. But if you start to notice that you're kind of going down that path, right, where day in and day out, you're not becoming profitable, you're not making trades, you feel frustrated, you feel blindsided by the market, and you get these unpleasant surprises much more often than not. That kills our morale, that kills our confidence, that takes all the fun out of trading. Takes all the fun out of trading. And we don't we don't want the fun to go out of trading. We want to make sure that we're enjoying this. Trading is I enjoy getting up in the morning. I wake up and honestly, I'm out of bed for 5 minutes before I'm in front of my computer looking at charts. I can't wait. I love to look at charts. I love to see what happened overnight. I love to just kind of get a good feel for how everything's looking. It's fun. It's great. It's awesome. It's the way to go. So trading should be fun. And if you're not having fun, I'll try not to make another old person joke because I think I might be one of the younger people in the group here, but so you guys are welcome to hate me. But at my ripe old age of 40 here, I'm starting to realize I want to do things I enjoy. I'm tired of doing things I don't enjoy doing. And if you have lost the fun from trading, if you're not enjoying it anymore, let's bring the fun back, because watching the market is awesome. I love doing it. I love seeing that what I have learned and what I have put to work gives me money directly. It's awesome. It's so great. And I want you guys to have that as well. I want you guys to have the success. I want you to have the enjoyment, and I want you to kind of get back to just what this all started off to be, which was, a venture where you could make some money, have some fun, learn some stuff. It's all great. So that's what we're going to talk about today. We're going to hopefully, the material here will get you much more on the path of knowing and even further from the path of guessing, right? We got to get away from guessing. I talk to traders, as I mentioned, all day, every day, and I hear people say, the market's too high, the market's too low, whatever markets they might be referring to, they're too one way or the other, right? And I always say, why? Why do you think the market's too high? I don't know. Why do you think the market's too low? I don't know. And so what we've got to get away from is just, what we hear in the news and what we see and so on around. And we want to get to a point of knowing. Now, there's nothing we can know for absolute surety, right? They're just, death and taxes are probably the most guaranteed things we have out there. Everything else we can know to a certain degree, right? And trading is absolutely that. I swear sometimes people think that I have a crystal ball and that I can predict what is going to happen, and I can't. As a trader, I cannot predict anymore what is going to happen to the market in 5 minutes or 2 hours or 3 days or 4 days than you can predict what the weather's going to be like tomorrow or the next day. But we can surely get close, right? We can get there with a very high degree of certainty, and that is awesome, right? I don't know the future. Anything could happen. Anything could happen. And remember, we have big political things constantly in the works and a natural disaster. I don't know. Anything could happen. And so we don't know 100% what is going to happen, but we can say with a very high degree of certainty what will happen. And that's what we do in the group on a regular basis. Exactly, Mel. We take some fantastic educated guesses. So these are kind of the paths we want to play on. Good, Chris. I like that. Open an account just to get in there and get it out of your system. Do some of the crazy trades. Yeah, I like that. That's awesome. That's a great way. It's a great way to do it. Okay, so as we move from guessing to knowing, there's going to be some paths we're going to take, right? Number one, I am a very big fan of technical analysis, right? What's technical analysis? Everyone clear on technical analysis? Probably the most used term in Forex trading and maybe trading in general. What is technical analysis? Is it a comparison of animals, of bulls and bears, apparently? Funny enough, as I think about this now, where do bull markets, I guess I see I would just be curious. I never, it's funny, in almost 20 years of trading, I've never looked up the actual story behind bull and bear markets. Bull market. I guess a market that's charging bull. I don't know. Why are bears such downers? They seem like they're pretty aggressive too. I don't know. Anyway, be interesting to find that out. But I'm a big fan of technical analysis, and I think that it is super, super important. And so this is kind of our first step, right? This is a first step to getting a good feel for what the market is doing. We've got to be able to read the charts. Guys, we are experts in analysis. That's what we've got to become, as experts in analysis. It's just like, I've said this 1,000 times before, but you go to the doctor, they take an x-ray and they show you this, and they say, oh my gosh, look at this x-ray, and you're thinking, I have no idea what you are talking about, right? You look at that x-ray and it looks like clouds and dust and, you know, and burnt marshmallows or whatever. It's just a crazy looking chart, right? Or picture. But they can see it so super clearly, right? Oh, you have this fracture right here. And you're like, how can you tell that's a fracture compared to the rest of these squiggly lines on this? But it's crystal clear to them. And that's what we need to become, right? As we look at these charts, we need to just be able to very, very quickly say, okay, I see things that are happening. But at the same time, when it comes to technical analysis, I'll look at a chart sometimes and I'll think, that's a terrible looking direction. And then I'll run through a few of the steps that we're going to talk about in a moment. And I'll think, never mind, I take that back. This is a great looking trade. So I never try to make too much of an assumption on what I see until I've run through the steps of technical analysis. And we'll talk about what those are. Mel, I think that's true, and that could be it, right? Bears can go downhill quickly. That's got to be. Maybe bulls run uphill fast. I don't know. Charging something. It's a good point. So to kind of go on that technical analysis kick for a second, as I said, I am a huge fan, to the point that I nearly live and die by technical analysis. But there are other important facts here. So the basics that I look for, and you know, in case you're coming and you're thinking, you know what, my trading's just off track, and whatever advanced secret stuff that you're going to talk about, Jared, Mr. Guy on the other side of the internet, I just need to get to some basics. I'm having trouble with basics. Well, these are the basics that you should absolutely be looking at every single day. I always am crystal clear about the trend of whatever it is I'm trading. And that's not, you know, I'm a currency trader, right? I trade stocks and options and everything else as well, but we'll talk specifically about currencies here. If I am trading the euro versus the US dollar, for example, or any other pair, right? I am crystal clear about what the trend of the euro versus the US dollar is. But I am also crystal clear about what the trend of the US dollar versus everything else is, and the euro versus everything else. I'm crystal clear about those because those trends are very, very important. And we need to have a very clear picture of that before we enter a trade. So know the trend of the currency pair that you're trading, but also know the trends of the two currencies in those pairs. Excuse me, in that pair. I'm very interested in channels. I'm very clear on where the currency that I'm trading is in relation to the channel. And the channel I'm talking about here is kind of a, you know, I'll go to a daily or a weekly chart, right? And I want to find a channel, and I'll show you some examples. I'm going to show you plenty of examples here. I'm very clear about those channels, right? I want to make sure that I know the channel of the euro dollar, but I also want to know the channel of all the dollar pairs and the channel that is showing up on all the euro pairs as well. So these are our rising and falling highs and lows, right? In an uptrend, we're bumping along those channel highs and bumping along those channel lows on the way up, and vice versa. So super important. I'm interested in patterns, although I don't watch patterns as much. I'm a big fan of head and shoulders and double tops and bottoms. I used to trade, you know, a lot of other different patterns because they, you know, with a lot of volatility, patterns can be awesome. But now when we have a bull flag, it usually ends up reversing quite a bit before continuing on. And so, you know, those kinds of things are a little bit less, but I still always am aware of the patterns that I see on the charts. And then absolutely, positively, without a doubt, support and resistance. I am crystal clear on where support and resistance levels are on whatever currency pair that I'm trading, long-term and short-term. And I'm crystal clear about where those major support and resistance levels are on all the corresponding pairs. Again, if I'm trading the euro dollar, I know where my support and resistance are on that pair, as well as all the dollar pairs and all the euro pairs, because I want to know where there is likely to be a reaction. And I recommend to everybody, trade around these reaction levels, trade around strong support and resistance levels, find channels, stop trading in the middle of channels, find patterns, use those to your benefit. stick with the trend, watch trends as they reverse, all of that stuff. These are the 4 basics that I look at every single day. Every single day, I'm looking at trends, channels, patterns, support, and resistance. So if you're here for a little reminder of some of the basics, these are some of the most important basics right here that you can look at. Absolutely most important basics. This is trading 101. And I don't know if you remember, who was the famous coach? I feel like I brought this up before, but who was the famous football coach that would say, this is a ball, and there's the end zone, and you run with the ball and you cross the end zone, and this is a football field, right? Because really when it comes down to it, we've got to have a solid knowledge and comfort level in the basics. Basics are of the utmost importance. We cannot have a solid trading strategy or trading plan without having the basics in place. Rick, technicals. Well, Rick, we're going to talk about technicals. We're going to talk about the fundamentals as well. So I think you have to be very well versed in both. But yes, in Forex, I would say, I trade a lot of stocks and options, and I would say technical analysis is even more effective in the currency markets than it is in individual stocks. Absolutely. Yes, Chris. Yep. Breaks of double tops and bottoms. That's great. That's great. Okay, so live and die by technical analysis. We've got to know these things because they are so important. So important. This is a sad trombone, by the way. Anybody know the wah, wah, wah? I feel like that sounded pretty good. All good things must come to an end, right? Trends reverse. This is why we've got to know how to read trends. Channels break out. Patterns fail. Support and resistance eventually doesn't hold, right? So we've got to know what's the difference from, has anybody ever heard of a quintuple top or a quintuple bottom or an octuple bottom or an, whatever it is, right? Typically no, right? Because at some point that support or that resistance level is going to break. At some point, our channels are going to reverse and break out. At some point, our trends reverse and break out. So we've got to know how to identify these things. But what gets tricky is how to identify when these things are reversing, when they're not going to continue going in the direction that we hope that they're going to go. So that's why we've got to understand technical analysis as best as possible. And then we've got to be able to identify the early signals of when our technical analysis is telling us that something is changing, right? Technical analysis is based on something has happened, therefore we expect that same thing to happen, right? The market's been running up and it's pulling back, we expect it to continue running up. It's been running down, it's bumping up a little bit, we expect it to continue running down. And that's generally true, right? But what I don't want to see you guys doing, and what I want to help you to avoid to do, is see a chart that's run up 800 pips and you think it's a good idea to start buying it now, right? This thing's been going up for 6 months. I think it's time I get in. It's been going up for a year. I think it's time I get in. No, we don't want to do that. So we want to be able to identify the beginnings of trends and the ends of trends. Now, I'm not even going to try for a second to tell you that we can pick tops and bottoms, but we can get pretty darn close. For those of you that are in the trade group with me, you've seen us pick some tops and bottoms multiple times. It's not something we've done once or twice. I don't ever try to do it. I always try to do it, but I always plan on it not working, right? Because it's very difficult to pick tops and bottoms. And so we have other strategies that help us deal with that. But we've got to be able to identify how these are working and when these are going to stop working, right? When our trend is going to stop being an uptrend and start being a downtrend, right? Super, super important. That's right. Close works. Close works just fine. It's true, Bob. We've had a couple of really close calls to the pip. Yeah, it's been interesting. So, no, very good stuff. It's been awesome. So what we've got to be able to identify, guys, is risk ahead. Is there risk ahead? Yes, no, maybe. That's what we've got to learn. And so the way that we're going to start doing that is by correlating other charts. How many of you, just for example, look at just your, let's say that it is a stock, you're looking at a stock, you're looking at a currency, whatever it is, and that's the only chart that you're looking at. You're trading the euro dollar and you're just looking at the euro dollar. We've already talked about how you need to look at every dollar pair and every euro pair, but if you're trading the euro dollar, how many of you would just, I mean, and no judgment here, but I'm actually just curious, how many of you would just say, yeah, if I'm trading the euro dollar, I just want to look at the euro dollar. That's all I need to look at. How many think that how many of you, for how many of you is that true? And for how many of you is that not true? Good, Chris, good. 20 pairs every morning. Now, it's one thing to look at a bunch of pairs, but if you're planning a trade on a certain pair, are you just looking at that pair to trade that pair? Now, by that I mean, can you get more information about trading the euro dollar from other charts outside of the euro dollar? Now, we've already talked about looking at all the dollar pairs and all the euro pairs, but what other information can we get? What other charts should we be incorporating? So today we're going to talk about pretty much all the charts except for the currency charts and how they pertain to the currencies. And I hope this is helpful for you because it's quite important. It's quite importante. Yeah, thanks for your honesty, Greg. Yeah, it's hard, you know. That's pretty normal. It's kind of what we do. Hey, if I'm trading the dollar CAD, let's look at the dollar CAD. Let's see how it's going. So I specifically will use these various charts here to help me determine where things might be headed on the currencies, right? Who knows what the VIX is? I'm sure most of you know what the SP and the Dow is. These are the various indices here, but anybody looked at the VIX? Anybody know what the VIX is? Anyone look at the VIX? Anyone look at bonds? Anybody look at yields? Any of that stuff? Good, Vlad, good. VIX, question mark? What is that? Excellent, excellent. So you're gonna learn some good stuff today. Good, Bob. Yep, I know you do. You're good at this. Okay, so we're gonna talk about what these charts are and kind of what they tell us, right? And what they're gonna do for us as currency traders. The VIX, this measures volatility and investor sentiment, right? Basically is the market, and the market, of course, is us. We are the market, right? We're the market. Yeah, good one, Chris. That's good. So, but investors, the big money investors, right, that are, you know, really putting the big movements and the big volume in the market. The VIX will measure a lot of different things, but specifically that investor sentiment. And when investor sentiment is down, the market's not doing good, right? When nobody's buying, the market when there's no buyers, there's nothing to do, right? The market is coming down. And by the market, I mean specifically stocks, right? But we're going to talk specifically how currencies relate to stocks and to this VIX and to all of this stuff, because we're currency traders. And some of you might be stock traders. I trade stocks as well. But we want to make sure that we kind of understand this correlation. So the VIX, basically, you may have heard of this referred to as the fear index, the fear gauge. When the VIX is high, fear is high, right? We don't want the VIX high because, I mean, as currency traders, we're okay with that actually. But in the market in general, you know, the typical stock trader, the Warren Buffetts out there, they don't want to see the VIX high because that means the Dow and the S&P are going to be running down. If fear is high, the stock market sells off. And I'm going to show you a VIX chart and a bunch of key times of that we'll all recognize, 2008 and so on. So the VIX is the first chart I look at. And this is just, again, our look at how is everybody feeling, scared or confident? How are investors feeling, scared or confident? Yes, Vlad, I'm going to show you. You can see it right on your TradingView charts. And if anybody is not connected with TradingView, help me help you. because we need to get connected with TradingView. I actually have an affiliate link I can share with you guys. If anybody does not have TradingView, you want to get it. There's a great free version, so it doesn't even cost you any money. Okay, so the VIX is super important. I'm going to show you some examples of this. The Dow and SP, right? We're going to start looking at the various how the various large sectors and the indices are doing, right? How's the S&P? How's the Dow? Is the stock market in general up or down? If investor sentiment is strong, the market goes up, usually. So there's always that slight variance there. But if this investor sentiment is strong, and it would be strong because the VIX would be down, right? The VIX chart would show some low levels. And I'm going to show you this chart, fear not, but we would see some low levels on the VIX, and we would see some upward movement in the S&P and the Dow and so on. Everybody with me so far? If investor sentiment is high and strong, the stock market's moving up. If it's scared and we see the VIX high, the stock market is moving down. Again, I'm going to show you how this pertains to our currency trades. Okay, everybody got those two correlations? Just let me know that you're still with me here. Everybody still with me? Yes? We're awake, we're alive? Because this is there's going to be a lot of up and down business here, and I want to make sure that you guys are feeling it and feeling okay, because this is real important stuff. Okay. Good. All right. Excellent. Excellent. I just want to make sure I'm not chatting too much, not giving you guys a chance. Okay. Good. Good. So VIX down, stock market up. VIX up, stock market down. Well, one thing that I really love to look at, and this one's a little more tricky, right? We have bonds and treasuries. I use specifically an ETF, an exchange traded fund, right? I use an ETF that tracks U.S. bonds and treasuries, typically 20-year bonds and treasuries and so on, to just kind of watch that price and that demand, right? So now, just out of curiosity, what is anybody's guess here? Do you guys think that bonds and stocks are the same kind of investment? You hear people talk about stocks and bonds, right? Trade stocks and bonds. So do you guys know what the purpose of trading, typically the position that stocks will take in somebody's investment portfolio versus bonds? Anybody know? What's kind of that main difference between investing in stocks versus bonds? Yes, James, good. Bonds and treasuries, these are safe investments, right? They're low yielding, safe investments. So people will usually have stocks and bonds in their portfolio. Stocks are that higher risk, higher gain part of your investment, and bonds are the real low risk and real low gain, right? Bonds pay a small portion of what a good performing stock can do. If you see, we've seen plenty of stocks over the last several years. Big companies have doubled their market cap, meaning their stock went from $100 to $200. You're never going to see that kind of movement in bonds, right? Because bonds are safe and steady, and they're just real easy going, right? So a good balanced portfolio has stocks and bonds, one that's kind of safe and steady, and the other one that is risky but can make you some more money, right? So what does that tell us? Well, if investor sentiment is up, yes. If investor sentiment is up, bonds are usually down, right? So if investors are feeling, we call this if the risk appetite is high, right? Then they're buying up stocks. They're feeling confident about the market. Everything's looking good. The market's cranking. So we're going to be buying stocks, and bonds are going to be in the corner going, hey guys, don't forget about me. But nobody's going to want a bond that is paying next to nothing and is real safe and slow and boring. They're going to want to get in stocks, right? Something that's going to be moving and going along. So it's all about, if that investor sentiment is up, bonds are not doing well. If investor sentiment is down, everybody wants to get in bonds. They're panicked about the market, right? So that's where we start looking at the difference. Oh, Chris, risk on versus risk off. It's an interesting term. It's a very interesting term. So along with bonds, we're going to be watching yields. Who knows what yields are? I mean, this is crazy stuff. I feel like I'm giving an investment planning seminar here, but I promise this is all going to be very, very important for how we look at the currency market. So yields. Good. Thanks, Chris. I'm glad you're liking it. Yields are, so remember, there's just four things we're talking about here. We're talking about the VIX, we're talking about the stock market, we're talking about bonds, we're talking about yields. And we're going to talk about how these all come together. So yields are basically what you get paid when you buy a bond. You buy a government bond, they tell you, here's the interest you're going to get paid. Here's the interest you're earning, right? Now, it's a very inverse relationship. If bonds are up, yields are down, meaning you get paid less on your investment if everybody wants to buy bonds. So for example, if everybody's panicked about the stock market and they're saying, forget the stock market, I'm going all into bonds, then bonds will go up and yields will go down, right? Price of bonds is gonna go higher, and the amount that you're gonna get paid is gonna go lower because everybody wants them. Basically, it's it's the government in their nicest way. It's the market, of course, but it's the market saying you're going to buy these bonds anyways, so we don't have to pay you as much. So demand is up, we don't have to pay you as much. You're going to buy them anyways. But when demand is down, when the stock market is cranking, VIX is low, everybody's feeling confident, nobody's going to want bonds, and those yields are going to go up. Right? They're going to say, come buy some bonds. We'll pay you more money. We'll pay you more than we were paying you when everything was really crappy in the market, right? So yields and bonds will go opposite direction of each other. Does that make sense? Everybody with me so far on bonds and yields? Everyone feeling that? Are you guys all, does that make some amount of sense? Some sense? Good and good. All right. Excellent. So we want to make sure. All right. Hello, Tolu. Welcome. Okay. So perfecto. So now let's talk a little bit about how this all comes together. Chris, you beat me to it. This is how we determine a risk on versus a risk off market. Risk on versus risk off. So in this way right here, a risk on market is investor sentiment is bullish, right? Investors are feeling strong. Nobody wants to be in bonds. Everybody wants to be in stocks. Volatility is low. That's risk on, right? Risk on is like, game on, folks. We're jumping in the market. We're going nuts. We're going crazy. This is all very exciting. Risk on. Risk off is just the opposite, right? Investor sentiment, bearish, right? VIX might be higher, stock market is flat or moving down, money is shifting into bonds, we're getting paid less for the yields, everybody wants bonds, we're not getting paid a lot for the yields. That's a risk-off market, right? Is everybody clear on that? Does that make sense? Does anybody, I will stop, I will take as long as I need to, so don't hesitate. Is everyone feeling okay about all that thus far? Okay, good. All right, let's move on to the next. So this is a risk on versus risk off market. So for example, we'll just look at this one more time, little visual here. VIX low, S&P high, bonds, treasuries low, yields high. That's risk on, right? Risk off, I would say I'm surprised if I didn't mess this chart up because it's even hard for me to kind of make sense of all this half the time. Risk off, VIX is high, S&P, Dow low, bonds are high, yields are low, right? Risk on, risk off. Everybody good there? Okay, we're good? We good? All right, so that is that's how we're starting to look at things. Okay, so now what we want to start to keep an eye on is how will the currencies react to all this? We've talked about the VIX, we've talked about the Dow, the S&P, all this stuff. Now, you may be wondering why I don't have the US dollar here, and I'll tell you that in just a second. But in a risk-off market, we're going to see Swiss franc strength. We're going to see Japanese yen strength. We're typically going to see Australian dollar weakness. We're typically going to see New Zealand dollar weakness. Now, the US dollar used to be very, very tightly correlated, and it's kind of back and forth now. It's a little bit back and forth, and kind of how it goes there. Chris, I would have the CAD in there. The CAD's definitely a commodity pair. For me, at this point right now, the US dollar and the Canadian dollar, no offense to our Canadian friends, it's a little more of an afterthought. The bigger drivers right now are definitely Aussie, New Zealand, Swiss, and yen. Those are the big drivers, right? I don't have the euro on here. I certainly don't have the pound on here because there's too much Brexit craziness. I don't have the CAD, and I don't have the US dollar. The US dollar used to be a very big driver. It's not so much anymore. US dollar is really just kind of, you know, to some degree it follows the stock market until it doesn't, right? So the US dollar and the Canadian dollar are a bit less correlated, tightly correlated as these four pairs are. So there's other pairs, right? And they do react in their own ways, but these are the tightest correlations that I believe we need to watch the most closely. But you're right. There are other ones to look at, and there's other things to do there, but these are the tightest correlated pairs. So that's a risk-off market, right? And so I want to look at some examples on the chart here, but these are very, very important. And very specifically, maybe even more than the Aussie dollar and the New Zealand dollar, is the Swiss and the yen. These two are, we have to watch so carefully and closely. And remember, we have the Aussie Swiss and the New Zealand Swiss and the dollar Swiss and the pound Swiss and the euro Swiss and all kinds of different Swiss pairs, right? And we have the same with all the yen pairs, and we have the same with all the Aussie New Zealand pairs. So there's, just by looking at these four pairs, we have, you know, 25 or 30 things to look at, right? There's a whole bunch of things to look at. Yes, I will post the video, the webinar recording, absolutely. So if we want to look at some of these examples in the charts, let's go right to it. Here are the charts that I look at. Once again, guys, I'm keeping a very, very close eye on, well, and I didn't really talk about this so much because we're kind of on the interesting US dollar route, but I look at the DXY. That's kind of one of my go-tos. But if we just start right here at the bottom, right? This is the VIX, V-I-X. This is a super important chart. So this is that first one that we talked about, right? We said the VIX, we've got to know what's going on with the VIX. This is our investor sentiment chart. So this is what the VIX looks like. Now we can find some pretty key moments here. For example, who remembers in the stock market in general, who remembers the massive sell-off that we saw starting to happen kind of September, October of last year, about a year ago? Does anybody remember that in the stock market? We started to see stocks really taking a bit of a dive, right? And that was about September, October, right? So here's, you know, we have the VIX right down at these lows. I mean, how textbook can this be, right? September, October, the VIX is down at the lows, the stock market's doing great. And what happens? It starts to just, the VIX just spikes, right? It just goes just about straight up. So the levels, this was sitting at about 11.5, and it ran up to about 28, 29. So big, big run here. We'll talk about the Aussie yen for sure. So it makes this big run, right? And how is that reflected in the stock market? Well, we'll look at that in just a moment, but big run there. And then as you guys remember, the stock market kept selling off, right? It kept selling off from September, October, and then it hit its peak or its biggest dip the day after Christmas, right? On December 26th, the stock market made this rip-roaring return, and that's where the VIX peaked right here. It got all the way up here to 35, which is about 3 times the normal level that we see the VIX. So it gets way up there, and then it just pulls all the way back, right? All the way back to 11, all the way back to this low in April. How does that look in the S&P, for example? Well, here's the S&P. This is the SPY actually, but same kind of movement here. Here's our September. We start getting this little sell-off, right? Everyone's saying, it's no problem. It's no problem. Little sell-off in September, little consolidation in October, and then whammo, right? We get that big dip, and we see that exact same spike. That is this spike right up here, November, December, right? The VIX shoots straight up, and stock market, S&P, Dow, they shoot straight down. And where do they turn around? December 26th, we hit that massive low, and we get that huge comeback all the way into April, which we see here in the VIX, right? Runs all the way up here, comes all the way back down. Everyone feeling good about that? Is that making sense? I have daily, weekly, and monthly pivots, Chris. Daily, weekly, and monthly pivot points. Everybody with me on just this simple correlation between the stock market and the VIX, S&P and the VIX? Is that making sense? So let's go. We can look at a few other things on the VIX here just for a moment. We had some kind of panic, freak out stuff that happened in the beginning of 2018. I remember watching this, and we saw the VIX run all the way up to 50. That was pretty terrible. And if we look at that over here, come on, internet. Come on, internet. If we look at the beginning of 2018, same big aggressive spike down, right? So we're seeing these guys correlating pretty well. Well, let's add an extra layer on here. So if the stock market started to sell off in October, November of 2018, look where TLT is. This is the chart that tracks bonds. So we have this way down at this nice little low level, right? This is tracking these 20-year bonds and treasuries and so on. We're down here. This is October 2018, and it literally almost doubles. It adds, it gains 50. Well, let's see. Let's see what kind of percentage we're talking about here. Oh, adds a third. 30, about 33%. Gains about 33% from that October time where the market starts to sell off to, we get this recovery here, little recovery here, but by this point, everyone is so panicked, right? So we have this big sell-off, everyone says, forget this market, I'm out of here. And of course, that's when it makes its biggest comeback, but we see all this money shift into bonds, right? The market turns very risk off, and we see these kinds of movements. Now, everyone kind of made a little bit of a recovery, but then we had, what did we have? What was our next big event? The interest rate surprise of July 31st / October 1st, or excuse me, August 1st, right? Where interest rates were cut in the US, but they weren't really expected, and all this stuff happened. Bonds shoot up again. Everyone starts buying bonds. So now we're looking at all this, and we're seeing, okay, money's flowing into bonds. It's been leaving the stock market. It's doing all this stuff. How are treasuries looking, right? So where do we get to that? Here's our yields, right? These are 30-year yields, and 20-year or 10-year yields look about the same. So here's this October, November, right? Yields are high as ever. They're just up here saying, hey, we'll pay you 3.5%, buy our bonds, buy our treasuries. And what happens? As soon as the stock market starts to panic, even though it comes back a little bit, everyone's pouring into bonds, and yields just go crazy down, right? All the way down here. We just see yields fall off the cliff because everybody can't get enough bonds. They're just buying it up like crazy, and so these yields go down. They don't have to pay as much because everybody wants them. So now when we kind of look at those moments right there, and we see these four different charts, we see yields, bonds, stocks in general, and the VIX, right? We're looking at all these and we're starting to say, okay, VIX is down, stock market's up. VIX is at its low, stock market's at its high. We're in this point where we're seeing now how these bonds, we've got the VIX. This is interesting, right? We've got the VIX at this low point, really low point. And every time it gets down here, what does it do? It gets down to this low point and it runs up. We get down to this low point and it runs up. And here we are spending a bit of an extended period of time at this low point. And what do we have happening right here? we have seen for the last at least week and a half, bonds have been running up again, right? So the VIX and the stock market haven't really reflected that yet. Stocks are up, VIX is down, but money is already shifting once again over here into bonds. And we're seeing yields, they've been coming down for the same amount of time, right? Now we've seen a little bit of stalling. We got a couple of bullish days there on the 10 and a couple of days on the 30, barely bullish. But we're seeing a little bit of a heads up potentially, right? This is bonds telling us, guys, we're getting a good little bit of money in the stock market or from the stock market here. So stocks might start to make a turn. If stocks make a turn, then we know we have some big opportunities coming with Swiss franc and with the Japanese yen and so on. Now I'll give you a quick little description of what we have on these charts. The Swiss franc, I love trading the Swiss franc. I actually really hate trading the dollar Swiss. That's the worst one to trade. So just don't trade the dollar Swiss. Do yourself a favor. But I love trading the Aussie Swiss, the New Zealand Swiss, the Euro Swiss, even from time to time the pound Swiss. But these guys are great. These are awesome to trade and they're super great. But what will happen is the Swiss franc will strengthen a bunch as volatility goes up, and it's the first one to react, right? Volatility goes up and the Swiss franc will just jump all over it. We'll see it flex its muscles and strengthen like crazy. When we see the stock market really react, that's when the Japanese yen will really start going. If the stock market really starts to strengthen or weaken, we'll see the Japanese yen do just the opposite. If the stock market's heading straight up, Japanese yen's weak. If it's heading straight down, we'll see the Japanese yen start to strengthen. And the same thing with the Swiss franc. As panic goes up, everything shifts over to the Swiss franc. As panic goes down, comes out of the Swiss franc. And we can start using those other charts to find the big moves on, at the very least, these yen and Swiss franc pairs. Okay. Yep. Divergence. I'll be honest, I'm not a massive divergence follower. I think divergence is interesting and I think it's useful, but it doesn't totally make it into my day-to-day trading routine, because I think I have some really rock solid things that will tell me as much or more than an indicator. So, but divergence is good. A lot of people look for divergence, and I only mention that because, you know, it is brought up quite a bit. But yeah, I don't really use divergence much. But it's interesting. A lot of people in my group do use divergence, and they'll say, it's interesting. You're always taking these trades where we have peak divergence. So whatever I'm looking at is pretty well correlated there. Okay, so now as we're looking at the Swiss franc, the New Zealand Swiss franc, and so on. No, not anti-Rob by any means. As we're looking at the New Zealand Swiss franc, let's look at some of these specific movements right here. What's this date right here? This is end of July, right? We've got end of July. Remember so we have this big sell-off, right? We have this big sell-off at the end of July, and that was, July was our, there we go, there's our end of July. Big sell-off, right? So stock market freaks out, heads down. New Zealand Swiss heads down. End of July, we see volatility spike, right? It's coming off this big low. We see that big spike in volatility. We see end of July over here, which should be right about here. Bonds shoot up as well. Bonds basically give us a run up and some consolidation, and they break out, right? The VIX coming off big time support, shoots straight up. TLT, oh, we already talked about that. Consolidation breaks out. And then we look at these yields, right? Here's July. We have that consolidation, that breakout, right? So we use technical analysis across all these charts, but when we start to kind of put all that together and we start to make that all kind of work, we can see very much so when we expect these breakouts to happen. Now, what's beautiful is oftentimes one of these charts will be a big time leading indicator for us. We'll start to see the stock market slow. Bond market will usually react a little bit earlier than anything else. because it takes a little while for the momentum to slow in stocks, and it takes a little while for that volatility to spike. So I watch the bond market very, very closely to get a good feel for that risk on, risk off market. But if I know I've got a risk off market where everybody's panicked and everything's kind of going nuts, I'm going to be real careful about being bullish, being bearish a Swiss franc. If I'm trading the New Zealand Swiss, for example, and I want to trade this higher, which I do want to trade it higher, I think these are at great levels. But if I think if those other charts are starting to show me that that we're now entering early stages of a risk-off market, then I'm going to be really cautious. And I'm going to say, guess what? I'm going to use this risk-off market. I'm going to use some of these other charts, the VIX, which is sitting at that low. And I think that as it sits at that low, it's got to pop at some point. And if the VIX pops up, what's the New Zealand Swiss franc going to do? It's going to run down. And it's going to give me a chance to get in. I think the New Zealand Swiss is a great pair to buy. And in fact, I really like New Zealand pairs right now. But I think that this is going to give me a great opportunity to buy this at a better price, right? So I want to kind of, I'm very interested in buying this against support, but I don't like this level. I'm a little far away from everything here. But now as I look at those other charts and I see that bonds are going up and yields are going down and the VIX is sitting at a big time low, that VIX is going to have to pop. And when it does pop, there's going to be a great trading opportunity. There's going to be an opportunity to be short this pair for sure, but better off, I think there's going to be a much better opportunity to get long off those lows. So that's how I'm going to start to use those charts. And we can just see these endless examples all along the way. Now, remember, one thing that we talked about here, as we're looking at stocks and we're looking at the VIX and bonds and yields and so on, and we're trying to identify risk on and risk off markets. Remember, when there's a risk off market, when everything's panicked and we see stocks not doing very well, the Japanese yen and the Swiss franc are strong. And likewise, we'll see the Australian dollar and the New Zealand dollar weak, right? We'll see these kind of weak when it's a bit of a risk off market. So when we see some panic, not only will I expect the Swiss franc to strengthen and the Japanese yen to strengthen, but I'm specifically going to expect the New Zealand Swiss franc and the New Zealand yen to very specifically weaken, right? So I'm looking at these. I know that these are two currencies that will react more heavily. We're going to see less of a move probably on the pound yen than we would on the New Zealand yen if it goes risk off market, because the pound yen's kind of in its own stratosphere, right? It's kind of doing its own thing. But we know that these commodity pairs, the New Zealand and the Australian dollar specifically, are going to get hit hard with a risk off market. And we know that the Japanese yen and the Swiss franc are going to strengthen a lot in a risk off market. So that's going to give us a couple of things to look at. That's going to give us an opportunity to short this pair. As we look at some of these bigger pictures and bigger things to look at, we could say, well, maybe this is the opportunity that that the New Zealand yen retest some of these, big significant lows that are 1,000 pips away, or something along those lines, right? So as we start to look at these correlations, we can see some very, very interesting and very, very helpful bits of information that can keep us on the right side of these big movements. For example, let's just look here and let's see how surprised we are about any of this stuff. Look at this high point. So New Zealand yen had kind of been trending down. It looked like it had bottomed out right here with New Zealand yen. We had this quadruple bottom, and we had this nice little, you could say that this was a pretty crystal clear descending triangle, falling wedge, excuse me. So we had a pretty nice little pattern in the works right here, right? This thing had been in this for, kind of started in this pattern all the way back here, October 2017, and it finally breaks out in October 2018. It had been in this descending channel for a year. It pops out, it runs all the way up to this high. Well, what happens at this high? I hope you guys are following me along with this, because this is just such important stuff. So now we're at this high, which happens to be a really long-term trend line for the New Zealand yen. This takes us all the way back to highs of 2014. Hits, 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 and we come back up to it again. So these are the decision points that I'm talking about that we want to be trading at, right? Well, how coincidental is it that this decision point, as we approach this in October, November, December, and what happens? The stock market takes a huge dip. Now, we actually happened to be in an Aussie yen trade when this happened, and that was super awesome. We made a lot of money in a short amount of time. But this hits this big resistance at the very not coincidental, because it's not coincidence, at the same time that we saw big, massive movements in the VIX, right? Here's October. You know, the VIX shot up and then it pulled back, and everyone said, okay, we're okay. We're okay. This is back down. It's back at a normal level. And then it starts going nuts again. December 2nd, 3rd, 4th. And this shoots all the way up to some big time highs. And we look over here at this New Zealand yen, and we see that the New Zealand yen hits this long-term resistance end of November, beginning of December. And what does New Zealand yen do? It shoots from 78.70 down to 69. It shoots down 1,000 pips in, we'll just say December 3rd to January 3rd. In a month, it drops 1,000 pips. Who wants to be in on that movement? Like I said, we weren't in on the New Zealand yen, but we were in on the exact same movement on the Aussie yen and the Aussie CAD as well. So between my two trade groups, we had a trade in either of them, and we made like, you know, we were in some decent profit, and then we ended up making, you know, an extra 300 pips in 20 minutes or whatever. So that was nice, little flash crashiness. But big movements, right? And we're not surprised to see a currency pair weaken, and a currency weaken, and a currency strengthen in a pair like this that reacts so much to volatility, stock market, bonds, yields. Okay, does that make sense? Is everybody with me so far? Can we see that? Can we see that? So we're going to go back to the very basics, guys, of technical analysis. We're looking at these charts. We're looking at these long-term patterns. We're looking at everything that's playing out here, right? This New Zealand yen has been in this big long-term falling wedge for a really long time. And every time it's hitting the top of this wedge, there are things that we can see on bonds, stocks, VIX, yields, right? The last time it hit right there and we had a real aggressive sell-off was when we had a very clear movement in stocks, bonds, yields, VIX, right? So these are super important to note. So as we do our technical analysis and as we start to line up on all the charts that we're looking at, then we start to see these things happening. And then we can say, okay, there's no way that I want to try to trade this breakout. I'm not anticipating this New Zealand yen to break out because, you know, and it made a nice little breakout of this shorter pattern, but I'm not expecting it to continue on through here because as I look at my other charts are telling me a completely different story, and I need to be short. I need to be trading this off of this big channel high. So very, very important stuff. Typically, Chris, the leading indicators will be the VIX stock market. Well, yes. So bonds will typically be kind of the leading indicator there. So bonds, and then the VIX will follow, and then the stock market will follow that. So typically in that order. So bonds and yields will kind of start to tell us the picture, which is what we're seeing right now, right? We're seeing the VIX really low and staying really low. We're seeing, you know, the S&P has come off this channel high a little bit, and this is a great channel, by the way, because this is a 10-year channel on the S&P, and it's hit, and we're right at the top again, and it's starting to curve down, and the VIX is real slow to kind of respond to that, but we can already see over here pretty aggressively that yields have been coming off that pretty hard, and bonds have been going up pretty hard. So these are definitely a leading indicator, and I'm just at this point kind of waiting for the stock market to follow, and then to be able to kind of correlate all of that into our next currency trades. So what I'm going to do tomorrow with everybody is I'm going to take all of this. We're having a second webinar tomorrow, and I'll have the details for you guys. It'll be in the morning, my morning, so some of you may not be able to attend, but we're going to have this webinar tomorrow that's going to show how we're going to use all of these to find trades of the next couple of weeks and months, right? I'm going to give you guys all my favorite trades and all the things that I think are going to be the best opportunities in relation to what we see happening in the stock market. So that's what we're looking at. Now, when we go back over here, does that make sense to everybody? Are you guys kind of with me on that? We looked at some examples on the charts. Does that make sense? Who has questions? Yes, I will post time. I'll send out an email to everybody, and just shortly, I'll make sure everybody has all the details. Good. Okay. Good, guys. Good. So I'm going to show you. You definitely don't want to miss tomorrow, because I'm going to show, further how we're going to use some of that technical analysis and how it can tell us what some of these charts are doing and where things are going. So it's going to be super cool. The big secrets will be just moments before. Thank you, Rick. Thank you, guys. So what we're going to talk about, guys, is really how to find some of those best opportunities. But what I want to share with you in the last 5 minutes before we go is how to implement this. And we use this stuff. For those of you that are in my live trade group, we implement this stuff every day. So it's one thing to talk about it, and it's another thing to do it. And we do it every single day in my trade group, in my live trade group. We look at these charts. We look at potential fear and risk on sentiment, and how we trade that, and how we position ourselves in our currency pairs for that. So it's super good stuff. It's always one thing to kind of hear it, and it's another thing to see it in action and make it part of your trading strategy. Somebody told me once, and it was a really funny statement, and it really stuck with me. And because I was talking to somebody about budgeting money, I said, I need to budget my money better. I really have no idea where all of my money goes, which is kind of crazy. And this person said, he said, it's interesting to change your relationship with money. You have to change your relationship with money. And I was like, well, no kidding, But then it sunk in, and it really meant something to me, because it reminded me that learning something and wanting to do it was not enough. That's a first step. Learning and wanting, the desire, is a first step, but then actually doing it is a second step. Human beings are infamous for being impossible creatures to do something new and to do something different. We hate new, we hate different. And so this is why I have this trade group, so that we can formulate those new habits and put to use and put to work all of this information that we're working on and that we're learning. Again, it's really interesting to learn this stuff and to think about it, and to think, well, I'm different. I'm going to use this. Others might not, but I will use this. Yeah, you might use it once, and then you'll forget about it, because you'll be really comfortable with what you already know. So this is why it's very, very important to join a trade group, and specifically a trade group that focuses on these kinds of very fundamental, very important trading techniques and strategies. So what you get in the trade group, we do 24 weekly webinars throughout the year. That's 2 webinars per week. Mondays and Fridays, we do 1 to 1.5 hour webinars, where it's instruction, it is information, it's Q&A, it's all very, very super important stuff. We plan our trades out for the week. At the end of the week, we talk about what we learned and how well we implemented all of the things that we discussed at the start of the week, and all the techniques that we know we should be using in our trading strategies. So the webinars are super, super important. I say, because I've done a lot of webinars of this type, I give these a $100 value per webinar. I would say there are $1,000 value, because these are so important for cementing in our minds the things that we need to be doing and that we need to be implementing. Along with all of that, it's not just talk. I post daily trade recommendations, very specific entries, very specific exits, and tell everybody exactly what it is we're trying to do, where we're getting in, where we're getting out. Nothing is unclear. It's absolutely crystal clear. Again, I give this a $2,000 value. If you traded $1 a pip, you would make 2 to 3 times that. So a $2,000 value is a low valuation, because you get a lot more out of that. So trade $1 a pip, you'll make $4,000, $5,000, $6,000 from following these daily trade recommendations throughout the year. I also, that's a typo there, but I also do a one-on-one session. I charge, depending on what is discussed, but I charge $400 to $500 for a one-on-one session. So that's pretty important. So those that join the trade group get a 1-hour one-on-one session with me to analyze your trade plans, goals, and so on. And you're able to really kind of get some one-on-one help and get you on the right track. These are all super important elements: group support, one-on-one help, and then very clear instructions on how to implement this day after day after day. It is of the utmost importance. And then along with that, we have a very, very excellent community from around the world. Many traders are in with us tonight that are already members of the trade group, from Australia to Europe to Asia to Canada and the US. We have an excellent community of traders where you can learn from me, as well as hundreds and hundreds of other successful traders that belong to the group. So it's a really, really great way to learn and grow and expand your horizons as a trader. Once again, if you want things to change in your trading, if you want to become a more profitable trader, you have got to change things in your trading to become a more profitable trader. You can't just want, you have to do. And this group gives you the framework to do and to get out of the want. So that's what we have it for. You get access to all of this. It's a $4,000 to $5,000 value. I charge $999 a year for this group. Now, somebody asked me, they said, hey, I want to join your group. Do I just go to your website? And I said, no, I only put up these websites and I only give access to my trade group a couple of times a year. So you can't just go to my website and join because it will be unavailable. You can only join during these webinars. And I do maybe 2 or 3 of these a year, and sometimes less. So I just want to make sure that we're a very tight-knit group. I talk to everybody before they join, and I spend an hour with everyone to make sure that they understand exactly what they're getting into and exactly how to make the most out of this. So if this sounds like something you're ready to do, head over to dtfx.co/join now. You've got the next couple of days here. This will be open and available till Sunday to join the group, and then it will be once again unavailable. But you can go right over here to dtfx.co/join now and become an annual member of our trade group. We'd love to have you. And if you feel like you're ready to do something different in your trading, then this is the way to do it. I hope this was useful and helpful for everybody today. Thank you for attending. Thank you for being with us. I will get this recording posted very soon, and you guys will be able to review this and go over the material that we have discussed today. Hopefully it was helpful. Does anybody have any questions or any comments before we wrap it up? Yes, Vlad, I do trade the VIX, but I usually trade it through ETFs. And I'll talk about that a little bit tomorrow. So if you can be in there tomorrow, it'll be great. I think tomorrow we're going to shoot for 9 a.m. Pacific time. I'll send out the email in just a few minutes, but it should be 9 a.m. Pacific, noon Eastern, 5 p.m. UK, whatever time that is, Australia time. So jump in there and be with us. Yep. And I'll talk more about the VIX tomorrow as well. So I'm planning on 9 a.m. Eastern. Keep an eye on your email. I'll send that link out in just about the next hour or so. Might be sleep time in Australia. Might be sleep time. Yes, and I'll be having the typical morning webinar as well. Yep. Great. Glad to see you guys. Glad to see you guys on here with us. Yep, we'll do our regular morning webinar, and then we'll do the follow-up to this webinar tomorrow as well. Thank you, guys. Thank you, everybody. Great to see you all. Head over to the website. Send me any questions. Reply to your email if you have any comments, questions, details. I will be here and happy to help. I hope all is well. Thank you guys for joining us. Hopefully this was helpful information. We'll see you guys tomorrow. Thanks, guys. Take care, everybody.